Germany avoids a recession as the whole of the Eurozone's economy grows quicker than expected. Welcome to Market Insight, I'm Ramzan Karamali. While GDP in the countries that share the euro grew 0.4% in Q3. A Reuters poll had predicted growth of just 0.2%. The biggest surprise came from Germany. The bloc's largest economy expanded by 0.2%, when most had forecast contraction and a technical recession. So does that mean Europe's economies are back on track, or does the outlook still remain weak? Well, to help answer that and more, I'm joined by Dr. Holger Schmieding, Chief Economist at Berenberg Bank. Holger, thanks so much for joining us. So let's start with Germany. Is the economy back on track, or is the outlook still weak there, do you think?
No, the economy is not back on track. Yes, the third quarter result was a positive surprise. However, the result for the second quarter was revised down from minus 0.1 to minus 0.3. If we take these two things together, then basically the German economy stagnated over the last 6 months. And that is probably an accurate description of the situation and the immediate outlook. Not a bad recession, but not really growth, either stagnation, until either the global situation improves or the German government gets its act together.
And what about for the rest of the Eurozone? What's your prognosis?
We will likely have, after this bounce in the third quarter, significantly more subdued growth late this year. We had this one interesting data point from Germany. We had in France a little bounce, a little help from the Olympics and the Paralympics. Looking at sentiment surveys, that has faded completely in France. So little help from France, little help from Germany, and probably a slight softening in the torrid pace of growth in Spain. That all adds up to a more subdued end of the year for the Eurozone.
Now, we've also got inflation data out of Germany today, and it came in higher than expected. And tomorrow we get Eurozone CPI data, which is also expected to rise. So what impact could this have on policymakers at the ECB then?
As far as we can tell from the data so far, especially the German data, services inflation is sticky. It is largely a reflection of labor costs, which, for instance, mean that for insurance services, in healthcare, health insurance, or in getting your car repaired, car insurance, we have significant rises, reflecting often, wages are rising nicely, more strongly than prices. And this wage pressure on service inflation will probably mean the European Central Bank will not dare to go with a big 50 basis point rate cut. They'll probably stick to 25 basis point rate cuts in December and early next year. And with the economy surprising a little to the upside for the third quarter, the pressure to really go big in December probably has gone away.
Now, how about the impact of the US election and possible further tariffs if President Trump is re-elected?
That is a serious issue for Europe. If Trump stimulates the US economy by deregulation, that would, of course, be a temporary positive also for Europe. But tariffs, or even just the threat of tariffs, would be a negative. We saw that in 2018, 2019, the first sort of inkling of a half-trade war, US-Eurozone, did hit the Eurozone and especially German manufacturing hard. It is not just the tariffs, it's the threat, it's the uncertainty, the confidence effect. So if Trump comes into office and then something on the table, if Europe doesn't behave, there'll be a big tariff on everything, then that on its own would likely dampen German growth next year by 0.2, possibly 0.3 percentage points, and for the Eurozone as a whole by at least 0.1. And if then Trump were to actually impose a lot of tariffs, then the damage to the Eurozone would be even more than that. Having said that, the damage to US households who would have to pay higher prices would also, of course, not be negligible.
Interesting stuff as always. Dr. Holger Schmieding from Berenberg Bank. Many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.